Well, hi everyone, and welcome to the Buffett and Beyond Saturday Stock Market Recap, May 10th, 2025. And remember, folks, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And this week, the market, well, what a week we just had. The Fed is waiting for more numbers as gasoline prices fall relative to the Fed lowering interest rates, just like banks around the rest of the world have already done several times. Now, the Fed is, as usual, playing a reacting game rather than a proactive philosophy. That's why they're always behind the eight ball, folks, because nobody's taking responsibility there. In other words, they would rather react to a recession rather than helping the economy so that the recession never occurs. Big difference there. And our weekly stock analysis video, well, BJ's is up 350% over the past 5 years, and it even performs better than Costco. But both stocks are in our growth portfolio. Both stocks are running all over the S&P 500 index. And our ETF video, well, let's go over the top ETFs year to date and also over the past 5 years. In other words, do the same ETFs perform better this year or this year to date than they have over the past 5 years, and we're going to see some differences there. And our portfolios are outperforming the S&P by double over 5 years. That's our 30 stock portfolio. And our ETF portfolio is tripling the NASDAQ 100, which outperforms the S&P 500. In other words, the NASDAQ outperforms the S&P 500. Our ETF portfolio is tripling the NASDAQ 100 over 5 years. And it is out in the ETF portfolio outperforming the S&P by 5-1 over the same time period. So, folks, we're doing pretty well out there, and we like the clean surplus methodology because it's not us, it's the methodology that we're using. So, folks, stay with us. And let's look at the market. Well, the market went through volatility bands, top line, bottom line, and the market went right through that 20-day moving average in here. Thought we were going to come down and have a double bottom in here, but we went up, and now we're at the top of that band, and we're sort of playing around in here. You can see we've gone nowhere over the past week, so we have to ask ourselves the question, are we going to go higher, or are we going to retrench a little bit and come back maybe to this 20-day moving average? But we're going to show you something in the next chart. But meanwhile, our intermediate term indicator is still going up. So as long as this blue line stays over this red line, we feel we're doing pretty good. The problem is that this histogram here has sort of rolled over, and we'll see what happens this week, folks, because earnings season's starting to come to an end. And we just have to wait and see how some of our larger stocks do over this next coming week as far as earnings go. And then when we look at the candlesticks, we want to look at this chart up here, and we can see we are at the top of that. Every time we're at the top, we have a correction. Well, this was a pretty big correction because here was this double top in here. Yeah, that was a giveaway there, folks. And over here, when it reached the top, you could see we had a decline in here and then rallied again. Once we got back down here to this line, this number 20 line. So here's the 20 line. Here's the 80 line, and in the middle is neutral. Over it is overbought. Under it or at it is oversold. So we have to be a little bit careful in here. But let's look down here. This green line is starting to cross over the blue line. The green line is a 20-day moving average. The blue line is the 50-day moving average, and that is like a little silver cross, they call it here. And so it's a minor silver cross, but it's certainly going in the right direction. This red line is the 200-day moving average. And folks, you can see we're pausing right under that over this past week. Went down to test that 50-day moving average, came back up again, and then just kind of fell a little bit here on Friday, But folks, we'll see what's going to happen here, because look down here, you see all these green bars? That is when the market closes up for the day. It's the volume. And the red lines are the volume when the market closes down for the day. And you can see the green lines are all always ahead of the red lines. So that means there's more volume on the up days, less volume on the down days. That is good for a continuing move in this market. And of course, as they say, the market is trending up, and the trend lasts until it doesn't. So they sound like economists. They say one thing, and then they say, but on the other hand. So yeah, the market will go up until it doesn't and stops going up. So those are the words of wisdom for the weekend. But you can see here, we're fighting for this blue line in here, 50-day moving average, which is support. The 20-day moving average is starting to move. Well, it's right about even with the 50-day, but we want to see a crossover in there. And then we want to see them both cross over, which might take 3 or 4 weeks to cross over this 200-day moving average. But in order for these moving averages down here to cross over the 200-day moving average, we have to see the market cross over that 200-day moving average and stay there for several weeks for these indicators to catch up. And you can see what happens when everything is ahead of the 200-day moving average. We have a nice rally, and if we go back further, we started all the way down here, and we came all the way up to here, new highs in the market up here. And then we faltered, came down because of all the tariff information, and now we're starting back up again as some of the trade deals are coming to fruition, which we all knew they would. So this was a panic sell-off. We always have to look at this bottom down here and say, will we test that again? And we'll see what the tariff situation is, whether prices go up. Because remember, the Fed mandate, even though I pick on the Fed's mandate is to keep prices steady. So they have to look at what the tariffs will do, raising prices on certain products. But then you think about how much we actually, or what products we actually buy, and do we really need them? So that's the key here, folks. And we'll see what happens this coming week. And as far as portfolio protection goes, well, because let's go back to this other chart, because we took on our protection when the market was all the way up here, we go 12 to 15% below the market, which was right around here, and those puts were protecting us as we fell below this area in here. So when we look at the portfolio protection, since we are still not back up in here, the puts that we have to buy, that we roll over and keep protecting 12 to 15% below this level, well, now those puts are more expensive. So what we did is we went out and we did some put spreads. In other words, we're buying the 520, which is about 12%, 13% below the highs of this year. And then we sell a lower put down here to cut down the cost. So we got into the July puts this past week, and it really didn't cost us anything because we sold a little bit of the May put, and then by doing this spread, we made some more money, and also we did a spread on another stock, Palantir, and also CrowdStrike, but Palantir gave us enough money to buy this spread, and it didn't cost us any money. So if you did that spread in there, which is akin to a covered call, and if you had 100 shares of Palantir, I said to sell a covered call on it, and the covered calls that most of you did was with the stock at 123, and now the stock is around 110. So they took the stock from us at 123, and now we have a chance to buy it back at 109, 110, and we just did another spread, so we'll pick up a few bucks to buy the September puts when they come due. And that's what we do, folks. We do 1 or 2 trades a month just to get enough money in order to be protected down here. And that's what it's all about. You can sleep, because a 10, 12% correction from the previous high is not a big deal. Not when you're looking at the long term and how well our portfolios have done over the past 22 years, which is 2.5 times more than the S&P 500, which is probably one of the best track records out there. So, folks, we had a pretty good week this week, even though we went nowhere. We went up and down and all over the place and ended up pretty much where we started the week, which is good. And we have the earnings starting to come to the end and of the earnings season for the first quarter, and we're getting some good projections for the rest of the year, and that's why the market has stayed up here, is because, wow, some of the companies are saying, hey, the tariffs aren't going to hurt us, or they're not hurting us very much, and we are looking forward to a good rest of the year. And as some of these contracts are signed, the tariff contracts are signed, the market will be happy once again, because it doesn't have to worry about that. So, folks, you go out, clear your head, have a good weekend, have a safe weekend, and we'll see you right back here in a couple of days with our daily letter on Tuesday.